She just finished up medical school. I think she said she's got about 100,000 in student loan debt. She has been working now for about a year. What do you think?
Yeah, so I mean that's case by case. Some of it's going to be dependent on her credit.
Mm-hmm.
So I wouldn't say that having a large amount of student loans is automatically, something that will kill the deal.
Okay.
But there's a potential option that we have where we can use an income-based student loan repayment plan. Now,
okay.
we would want to go. It's a conventional loan option. It's through Fannie Mae.
Mm-hmm.
So we'd want to make sure that credit is in a place where a conventional loan option is going to be best for her.
Okay.
And then with her working for about a year, I would assume that she maybe has not established one already. It's very possible she has. Sometimes when they're just working for a year, maybe that means she just got out of college. She might not have one yet. She might not be required to start paying yet.
Okay.
But if the client's open-minded to reaching out to whoever's holding her student loans, if she doesn't have this type of plan, and they're open-minded to, maybe starting to make payments a little sooner than they normally would, income-driven repayment plans are almost every time significantly less than what we would use to qualify them typically, which is what comes to mind in most people's minds. Student loan debt, it's going to kill my approval. That thought comes from having to use 1% of the balance. With $100,000, we're talking about $1,000 against their debt to income, which is, it's essentially somebody trying to get qualified for a mortgage while already paying a mortgage. You're paying $1,000, but so an income-driven repayment plan, depending on how, I wouldn't even say depending on how it's set up, because in most cases it's always going to be less than that $1,000. It could be $0. It could be $200. Whatever it is, even if it is $0, we can use it as long as they have an established plan.
Nice. Okay. So what I'm hearing from you, she needs to get an established plan or go ahead and start paying now, so that you guys will not have to use 1% of her debt, basically $1,000 to count against her debt to income ratio, which could affect her ability to get a loan. Correct? Is that what I'm hearing?
Absolutely, yeah, that's correct.
Okay.
So the main thing we would go over is credit first, because before we have her go set up a plan and start making payments, understanding that most likely right now she's probably not making payments yet. We want to look over and make sure that it is going to be the best option, because it's one particular loan program. It's just conventional and it's just Fannie Mae, so it's not even Freddie Mac.
Okay.
Freddie Mac does allow 0.5%. But even 0.5% in this case is still $500, in which, if we can get an income-driven repayment plan of anywhere from $0 to $450, it's still less than $500. But we'd want to look at credit, make sure that's going to be the ideal option for her. And in some cases, even if credit is not right where we need it to be for that option, usually it's still best for the client to maybe get some recommendations on how to improve credit, and then revisit that exact option once credit gets to where conventional is going to be best for them.
Okay, got it. So what I'm also hearing too, then, if she is FHA eligible, she's got a, and I don't know this just yet. Let's just say she's got a 640 credit score, for example. We're in trouble.
I wouldn't say we're in trouble, but I would say that it's going to be a game-changing situation. It's going to be what can we do to get that 640 to at least a 680? Because although conventional's minimum credit score is 620, there's a difference between qualifying and being eligible. So, like, you can be technically eligible for, or I apologize, there's a difference between qualifying and approving. So you could qualify based on guidelines, but that doesn't necessarily mean we're going to get an approval. And at a 640, depending on the amount that she wants to put down, I think that what that situation would be is not that we're dead in the water necessarily, but in order to avoid using that 1% that FHA is going to require regardless of your payment plan, let's do A, B, and C to get your credit up above 680 if we can.
Okay, got it. So FHA would automatically require 1%, period.
FHA is automatically 1%, and then if we go, let's say we go to conventional loan option, Freddie Mac gives the option of 0.5%, but that doesn't matter. It's regardless of if you're on a payment plan. Fannie Mae will allow the payment plan amount. However, the payment plan has to be approved and has to be open and active. It can't just be, because a lot of times clients will send in estimates or based on they'll apply for the plan, but they won't open the plan or establish the plan. As long as it's an open and active payment plan, we can use whatever's on that payment plan.
Okay.
But to answer your question, yes, FHA is 1% regardless.
Okay, fantastic, man. Well, anything else, man, that I may need to share with her before I get over to you?
No, man, I think that kind of covers it because, you know, as you're aware, with these pre-approvals, man, they're so individual to our clients that, you know, we don't want to give them too much information that may not apply to them. But I think, you know, if we cover this on a surface level in your phone call with her, once I get connected with her, I'll go in more detail.
Okay, man, I can always count on you, my friend. I appreciate it, Joell.
Oh, you already got it, big dog. I'll be waiting to hear from you. And if you need anything else in the meantime, just give me a shout.
Okay, man, listen, hopefully I'll see you.